Appreciate that. All right, so I mean, this confidence that we're going to start cutting by March feels like it's the backbone to this rally. Do you agree?
Absolutely. Powell could not have been more dovish today. He basically said that they're very much in restricted territory. He mentioned, as you just said a moment ago, that the six-month PCE numbers are 2.5%, and there's just no justification for 5.5% rates. So we have the Fed cutting in March. We have them cutting from March every single meeting next year, 25 basis points, to probably get to about 6 cuts by the end of the year.
Wow. And where does it come from, though? Is the Fed going to cut just because inflation has come down to still above their target? Or is this assuming we get below 2%? Or option C, is it the market saying it doesn't matter where inflation goes, Powell's just going to do what we say?
No, it is important where inflation is, but as you've said before, inflation is much lower than where the Fed is right now, and there's no justification for 5.5%. So just based on that alone, you don't have to see a recession, you don't have to see a weakening of the labor market, even though I think that's already happening. The Fed is going to cut, and that's it. And that, to your previous guest who talked about gold, absolutely. Gold and dollar are inversely related, and that's one of the reasons that gold's doing so well. It's not gold is an inflation hedge. It isn't, or it certainly hasn't been the last 20 years. It's an anti-dollar play, and that's what we've seen. And as well as you've already hit upon, the most important thing that few people are talking about is look at where the Russell is today. The Russell's up 2.5%. You're getting this rotation out of the high flyers into the weak part of the curve, and you're setting up for the January effect of small caps. So I think everything is perfect today. I just hope it goes into next week and goes into the Fed meeting in 2 weeks.
You're describing the everything rally again. You know, we really haven't had one of these basically since we dumped money into the economy during COVID. We've had a great year, of course, but it's been so tech dominated. Last year we got smashed, obviously, everywhere. So is this like telling us we could be back into the pre-COVID zero bound days? I mean, isn't that almost just an aggressive like bipolar switch from what we assumed was going to be the future just 6 months ago, Andy? It's a crazy pivot.
Absolutely. Well, it's a little different than that. I mean, what you had is people don't understand how much the Fed dominates where equity prices are going to be, and there is such pent-up demand from when the Fed has pivoted from a tightening to a flatness being done, and now to absolutely cutting rates. I mean, before I came on here, I looked at where January was. January has been an expectation of anywhere from 10% of a rate hike to 40%. It's now negative 10%. So I don't think they're going to cut in January, but they're definitely going to cut in March. Of course, we could have good numbers, and maybe that puts it off to May. But the Fed is going to cut, and they're going to keep cutting, and there's no justification for where rates are right now, given where inflation is.
Okay, fine. So I'll play along then with the idea that there's no justification for where we are. Let's say we need that first cut. Where the logic really breaks down for me is the cuts after that, the assumption that we're gonna do a V turnaround in rate policy. Because isn't the Fed doing a pause, wait and see? How come the pause, wait and see is what we should be doing now, but not on the downside too? Don't they risk stoking inflation if they blast the market off and cut? Is there no such thing as a wealth effect anymore?
Oliver, they move 525 basis points. They can easily cut 150 basis points and not cause any of that. The economy, while it's not going into recession, is slowing down. We see it in all kinds of numbers. You talked about some numbers today. We've been seeing it over the last couple of weeks. Yeah, sure, you've got some backward-looking number like GDP coming in at 5.1, 5.2, but the Atlanta Fed for the fourth quarter has got a one handle to it. So things are definitely slowing down. There's no reason the Fed should be where they are. There's no reason the ECB should be where they are. All the global central banks are going to start easing. And, you know, I think they're still going to continue QT, and that's going to be their stay for the time being. But rates just got too high.
Andy, what about the purported target of 2%? We're obviously still far above that. We're still printing low to mid threes. Even when you take out and look at the core and do whatever adjustments you want, we just don't have anything close to the target. So is the idea here that the Fed will start cutting before we get to that target, or is the idea that we are going to hit that target by March?
I think that target is ridiculous. And I think what you have to look at is where Fed funds are versus where inflation is. And 5.5% to 2.5% over a 6-month lag, or over the last 6 months, is ridiculous to have 300 basis points of premium. Premium is way too high. You can easily lower 150 basis points to 4% and still be 150 over the inflation target. Now, if inflation were to tick up, which we don't see, I'm filling my car up with gas under $3 a gallon. At one point it was pushing 4. I'm sorry for the people in the state of California, but that's the way it is here in the Northeast. And that is a big inflation thing. And it doesn't matter that OPEC thinks that they're going to cut back here and there. Gas is very plentiful. Prices are coming down. The Fed doesn't need to be where they are. 4% is more than enough for the Fed to get to and still maintain a restrictive policy.
Okay. And that's a very fair point, that spread is still restrictive. But just because for traders it's going to matter a lot. And the last point here, Andy, to come back to it, is do you think that Powell is actually serious about 2%? It seems to me that there's a strong argument that the market's being made now that he will cut before we get there. Do you think that's the case?
Oh, no question about it. It's going to be a while before we get there. I don't think that's a real hard rule. I think you have to be trending in that direction. I don't think 2% is necessarily a 2000, well, it certainly wasn't a 2023, and it might not even be 2024. From what I've seen in the Fed, they're talking about 2% in 2025. You have plenty of room to cut now. Oliver, what you should be looking at is Powell today, who was perfect. You should look at Waller at the beginning of this week, who also said the same thing, and Jefferson, who said the same thing about a month ago. The rest of the Fed governors you should ignore totally.
All right. Andy Brenner, great to catch up. Fun conversation for sure. A lot of conviction in your tone. We'll definitely catch up. Have a great holiday if I don't see you.
You too, Oliver.
All right. Thanks a lot. Andy Brenner. There we go. Thanks, Andy. Head of International Trading at NatAlliance Securities.